various growth scenarios to see that what profitability will actually emerge out of the business. And growth, obviously, for a life company can become very capital hungry channel, which is the problem. Is it the investments? Is the company not able to give good investment returns to the policyholders? Is that a reason why the general public does not want to buy policies of that company? Are there any external factors, law and order situation, any regulatory constraints because of which a company is not really able to grow? So I think all these factors are a challenge for the management to, the basic challenge is to identify the factors and then have a strategy to put things right, whatever has been identified. Lack of growth in bottom line, if the profitability is low, then as we looked at in the earlier slides, that the sources of profitability are investment income, expenses, having low expenses, having a good claim experience. If those areas are wrong, then obviously those need to be put right. The underwriting practices might have to be addressed, or the expenses need to be curtailed. If there are some fixed expenses, the company needs to identify which of those can actually be reduced. So all of those factors come in as part of active management of a life company. Products also are obviously key because that is what we are selling, and we are going out as a company and selling, and that is what is eventually going to make money for the company. So there are various questions. Is a simple product good or is a sophisticated product good? Does the product have the right fit to the target market? What features are being offered which probably the target market does not understand? For example, selling a very sophisticated product to a micro level target market would not really work because that target market does not understand, first of all, insurance. And if you offer them a sophisticated product, then you have the added problem of explaining that product. And in the end, if the client doesn't really know what he's buying, so you will have issues later on in the life of the policy. So these kind of, if it's a wrong fit to the target market, then eventually the problems will start. Is the product too expensive? Is the pricing not right? Is the price higher than what the competitors are offering? So that obviously needs to be looked at as part of active product management. What value is it offering to the clients? When a client compares the product of company A to company B, is your company B lower in terms of benefits to company A? Then what do you need to do to actually bring it at par with at least what the competition is offering? Does the product offer any guarantees to the client, or is it a non-guaranteed product? That can also have a significant impact. Also, having too many products, is that good or is that bad? That's for the management to decide. Or maybe the management does not have enough products on its menu. So having the right mix of products and having the right number of products and having enough products to cater to each of these market segments, that also is very important. Distribution, I think Madam touched upon that briefly in her presentation. I'll just carry from some of those points, that which distribution channel is right. Predominantly, historically, it has been the agent, the insurance agent, which has gone out and sold individual retail policies. But over the last 5, 6, 7 years, alternate to the agency channel, other channels have started to evolve. The most successful of them has been bank insurance, where insurers and banks have partnered together, and the distribution network of banks have been used to market insurance products to the customer base of the bank. So is that a channel which a company wants to follow, and does that make sense for the company? Is direct sales something that the company wants to look at, sending out maybe mail inserts to its customer base? Is that a way through which insurance can be sold? Telesales is something that some companies and some banks have looked at and also have had some limited success in that. So is that a model that is cost effective and can be used? Or the last one being through the internet, because in our life now, internet plays a very important role. So can an insurance policy actually be sold through the internet? So again, it's for the management of the company to see which is a cost effective channel. If a company historically has been following a very expensive distribution channel, probably it needs to reposition itself and move towards alternate channels, or probably create a multiple strategy where it has multiple channels, so that if one channel is more expensive, the other is cost effective, so at least some cost subsidy can actually come into play. Expenses, obviously something that I just mentioned earlier also, that is one of very important factors for the management of a life company and the new business strain and then even the later expenses. If they are not kept in check, they can actually make or break a life insurance company. Leave aside the investment performance, leave aside the claim experience, the persistency rate. If the expenses is one single factor which can actually significantly impact the performance and the existence of a life insurance company. Now there are two types of expenses, a fixed expense and a variable expense. Variable expense would be expense which is directly linked to the business, which is, for example, a major component of that is commissions that we pay. So if an agent brings in 100 rupee of business in the first year, we would end up paying him 35 or 40 rupees as commission to that agent. Now that is a significant component of the overall costs. And in some cases, if you take the total expenses of a life insurance company, 80 to 85% could actually be just the acquisition cost, the commissions and the cost incurred to get the business on board. And the remaining 15 to 20% would actually be the management expenses, the salaries of the head office, the overheads, the rent, electricity, all those types of costs. So a good budgeting function should be in place. A good function to monitor expenses very regularly has to be in place, and that is the only way the company can keep a check. The company might have to reprice its products if the expenses go wrong, and that can only be done if the company knows where it is heading in terms of its expenses. The economic environment also obviously plays a very important role. What is the interest rate environment? Are the interest rates very high? Is the inflation very high? Because all of that has a ripple effect on many other factors as well. If the interest rates are high, the market value of the investments that a company has, that an impact might come on that, and that would in a way depreciate the value of the investments the company has. If the inflation rate is very high, then we need to see that is the general public receptive to the idea of insurance? If they find it difficult to make their ends meet through whatever income they get, do they have extra income to actually spend that towards buying insurance? The law and order situation in our situation obviously plays a very important role, and then also the target market. Are those savers or are those spenders? Is it a period of recession or is it a period of boom? So all of those factors also play a role, and then the company has to reposition itself. For example, right now it is a high interest rate environment, it is a high inflationary environment. So then the company has to try and give a higher return, manage its investment in a way that at least the return gives at least some real return to the customer net of inflation. If you look at right now with inflation at in excess of 15%, a lot of investments are not giving a real return. It's a negative real return. So all of those factors then need to be factored into the company's strategy. And lastly, the regulatory side of it. I would say that there can be challenges associated with the regulatory side as well, because all of that depends on what is the regulatory regime in the country. Is it a friendly regime? Is it a regime which promotes the insurance business? Is it a regime which interacts more with the insurance industry rather than dictating regulations to them? How much does the regulator engage with the insurance industry? Is it a strong regulator? Is it able to enforce its policies? Or is it a weak regulator where, because of non-enforcement, many companies get away probably with a lot of practices which should be actually regulated? So it all depends on which market we are operating in. Also, I think the consistency of regulatory direction is quite important. That if there is a certain, let's say, a team within the regulatory department, and that has a certain vision in terms of how to take the industry forward, and a few years down the road, if the team changes and a new team comes in, then the consistency has to be there. If there are abrupt changes in the regulatory direction, then obviously the industry suffers to quite an extent. Coming to the last slide, just sort of summing up